Hey team, it's Matt from Universal CPA Review, the #1 course for visual learners. In this video, we're going to dive right into an acquisition method simulation. So basically you have two breweries, one buys another one that becomes a consolidated subsidiary, and we'll need to figure out the elimination entries for that subsidiary at the end of the period, right? So it's going to be awesome. And before we dive into the video, please subscribe to our YouTube channel, right? We have a growing audience and we want to keep growing it more. If you need some Facebook study groups to help you along in your journey, well, join our groups. The links are in the description of this video. And then if you want to start a free trial, see what visual learning is all about and see how powerful it is, then sign up for a free trial. And if you're interested in purchasing the course, well, just reach out and ask us about any discounts or promotions that we're currently running. Are we ready to go? Because it's time to attack this simulation on the acquisition method, which is a complex topic. Now, in the lecture, you learned all about your 6-step approach to eliminating an acquisition, and that's the method we're going to use here. So we're going to start by doing an overview of the simulation, making sure we understand the directions. We'll review the exhibits to make sure we understand what type of information is provided in the simulation, and I always recommend doing that before you dive into the task. And then the first real task that we're going to do is the entry to eliminate the subsidiary that's being acquired, and then we're also going to have to propose journal entries for the depreciation and amortization on the step up in fair value. So as the instructions indicate, our role is as a senior consultant with FWC, which is the accounting advisory practice of the firm. Right, and basically we've been engaged to help our client, Ryan Company, with the acquisition and consolidation entries for the acquisition they just made of Lem Brewing. The instructions then indicate that the advisory director of our team sent us an email that explains the task, right? So that's where we're going to have to go next. But run real quick thing here. Column A lists out the accounts impacted. Now, when it comes to the debit and credit columns, this is where it's important you understand exactly what you need to do, right? Because on the exam, it could say to put debits as positive numbers or credits as negatives. In this case, everything is going to be a positive number. And if there's a cell that requires an entry, but we don't actually need to put a number in there, you still have to put 0. Now on the exam, it could say that, it could leave it blank. Just make sure you understand the directions. So when we pull up the email from the advisory director, well, we need to focus on the bottom part, which is where the controller sent the advisory partner some information about their recent acquisition. And so basically, Ryan Company, they bought 75% of Lem Company for $6,750. Right, so that is not 100%, but it is more than 50%, which means that this is going to be a consolidated subsidiary. So it then tells us the entry they booked on the initial acquisition date, which was July 1st, year 3. And they basically just uploaded the trial balance of Lem Brewing Company. And so basically everything that's on Lem Brewing Company, that's now in the system. And so that isn't going to necessarily be what the consolidated trial balance would be at the end of the year, right? And that's why we need to record the entry to eliminate certain aspects of the subsidiary, as well as recording that additional depreciation and amortization, right? So we'll get to that, but I just wanted to highlight kind of how this all comes together. So in the email, it also says that Ryan Company hired Goodman Thomas to do the valuation work that related to this acquisition. So basically, you can see we have a valuation report that has a DCF analysis of Lem Brewing. And when we look at that, right, there's a lot of information that really we don't need. It basically just supports the fact that Lem Company has a $9,000 valuation, right? And if we did the math on the amount that Ryan actually bought of Lem, right, they bought 75% for $6,750. Well, if we assume that was 100%, that would be the $9,000 valuation that we're seeing in this DCF analysis. The other exhibit focuses on the valuation report from Goodman Thomas that lists out the book value of all the assets and liabilities, as well as the fair value, right? And it's important because think about it. When we uploaded that trial balance for Lem Company, everything was at their cost base, but it needs to be reported at fair value. So if there's a difference between the book value and fair value, well, that difference, it gets recorded in our entry, right? And that's all part of the 6-step approach that we'll go through. But now you see this a little bit more, right? And you can see that it's inventory, PP&E, and intangible assets that have a difference between their fair value and book value. And that's pretty common, right? We don't expect any difference in cash, other non-current assets, and then other current liabilities, right? It's typically those few items that have a difference when it comes to fair value and the book value. So the last exhibit they give us is the trial balance for both Rhine Company and Lem Brewing as of July 1st, year 3. So for Rhine Company, there's not much we really need to do with it since we're not doing a full consolidation. But I do want to point out that you can see in the asset section that investment in Lem Brewing for $6,750. Well, that's the entry they recorded on July 1st. Remember, that was shown in the email from the advisory director, right? And this is basically under the equity method. And since it's going to be a consolidated subsidiary, this is not the proper accounting, which all goes back to why we need to record this elimination entry at the end of the year for this acquisition. Now for Lem Brewing, this is the trial balance that would have been uploaded on July 1st. Obviously, all of their assets and liabilities were recorded based on whatever it was in Lem and not necessarily fair value, right? And we'll also need to use this for the net book value of identifiable assets, which is really that bottom part, right? The common stock, additional paid-in capital, and retained earnings. So the trial balance, they will need to give you this in a simulation on the exam because this contains a lot of important information. So let's start with journal entry number 1, where we need to eliminate the investment in subsidiary, right? So this is the simulation. This is ultimately what we need to fill out, but we're going to go ahead and go through our 6-step mental map approach for the acquisition method, and then we'll come back to this at the very end. All right, so here's our 6-step mental map, and this will guide us in the 6 steps that we need to perform. So I also brought up the 6-step approach in the journal entry format, right? And this is something you should be familiar with from the multiple choice questions. And basically it's our mental map, but in a T account format. And that is the best way to go ahead and plug the numbers in that we need. Now you'll notice this is just a bit different than what the simulation looked like. And so at the very end, I'll help you understand how to take this and plug it back into the simulation. So let's start with step number 1, which is the investment in investee, right? So going back to that email, we saw that on the acquisition date, they debited the investment in investee account, right? Which was basically the investment in Lem Brewing. And that was for the purchase price. And so what we need to do here is reverse out that from the asset section, which is why it's a credit here. So our step 1 is going to be a credit for that purchase price to acquire 75% of Lem Brewing, right? So that's the $6,750. Now in step 2, this is where we would record any non-controlling interest. And since they only purchased 75%, right, that means 25% is still outstanding. And that's owned by other parties, right? And so there's a couple of ways we could go about this, but probably the easiest way is just to take the full valuation of $9,000, multiply by 25%, and that tells us the non-controlling interest is $2,250, right? So that's what we would credit here. Our step 3 focuses on the book value of net identifiable assets, right? Because when we're in consolidation, we need to remove the equity related to the subsidiary, right? And that's going to consist of common stock, additional paid-in capital, and retained earnings. So that's basically equal to stockholders' equity. And so if we go to the trial balance that was provided for Lem, right, that's how we can get those numbers. So we can see that it consists of common stock of 1,000, additional paid-in capital of 2,000, and retained earnings of 1,500, right? And that totals to a book value of net identifiable assets of 4,500, right? So that's what we'll plug in for the debit for step 3. So steps 4 and 5 relate to the fair value adjustment. And that's just the difference between the fair value and the book value for fixed assets and intangible assets. So remember that exhibit from Goodman Thomas that did that comparison? Well, when we look at it, right, there was that $100 difference in inventory, and then PP&E had a $1,000 difference, right? So those are the two fixed assets. We can ignore the difference in intangible assets because that's part of step 5. And so that's from the exhibit. You can see in step 4 that that sums to 1,100. So that's going to be our debit here. Now, when we prepare the actual trial balance entries, we would split this back out. And I'll show you that at the very end. So step 5 is pretty much the same as step 4, except this time we're focused on intangible assets. And looking at that same exhibit, we can see that the book value was 500 for intangible assets, but the fair value was 1,200. And so that difference of 700, that's going to be our debit here. So now we get to step 6. And step 6 can either be a plug to goodwill or a plug to a gain. And so looking at the credit side, right, it totals to 9,000. On the debit side, we're short of 9,000 by 2,700. So that means we're going to debit goodwill for 2,700. So that is the full elimination entry using our 6-step approach. Now, as you learn for the multiple choice questions, this would pretty much answer any question they can throw at you. Now, the one difference here for the simulation is that we're given it by trial balance account. So as you can see now, basically here is the elimination entry by trial balance account. So for most of them, it's the same, right? Except for certain things. So for step number 3, the 4,500, you can see that it's now broken back out to its individual trial balance account. That's going to be the common stock for 1,000, additional paid in capital for 2,000, and retained earnings for 1,500. And then for the adjustment to fair value, which is step 4, which was 1,100, we had to split that back out between inventory and property, plant, and equipment. But otherwise, goodwill, that's a debit for 2,700. Intangible assets, that's a debit for 700. And then you can see the credit to remove the investment in Lem Brewing for 6,750. And then non-controlling interest, we also would credit for 2,250. And when we look at the total debits and credits at 9,000, guess what? That gets us to a balanced entry. So this is the entry. This will be the correct answer for journal entry number 1. So there are 2 other journal entries that we need to tackle, and they're fairly insignificant in comparison to what we just went through, but it is something that we need to focus on. So remember how we made the adjustment to fair value for the difference between the book value and fair value? And that was for PP&E and intangibles. Well, both of those items are either depreciated or amortized, right? And for the last 6 months, they would have been depreciating or amortizing based on the book value, but they should have used the fair value as the amount to determine the depreciation or amortization, right? And so what we need to do is figure out the incremental depreciation and amortization based on the useful life, the portion of the year, and that increase in fair value, right? So let's go attack the incremental depreciation for PP&E. So we'll pull up the net analysis valuation report from Goodman Thomas, right? And we can see the footnotes for both PP&E and intangibles. So starting with PP&E, we can see that really the difference is driven by land, buildings, and auto. But land is not depreciated, right? It has an indefinite life, so there's no depreciation there. However, buildings, there's a $500 increase with a useful life of 20, and then auto had a $200 increase with a useful life of 5. Right, so in this schedule now, you can see, basically we're going to take that increase in fair value for each of them, divide by the useful life, and that will tell us the incremental annual depreciation that should be recorded. Right, but we're only talking about July 1st to December 31st, right, after the acquisition date for our consolidated year, since we're only in year 3. And so in that case, we only need to do half the year, right, 6 months out of 12 months. So we'll take that annual depreciation multiply it by 0.5, and that tells us incremental depreciation for the building is $12.5 and auto is $20. And that totals to depreciation of $32.50 that needs to be recorded for that 6-month period. So what's the journal entry? Well, that's the easy part. We would just debit depreciation expense for $32.50, and then we would credit accumulated depreciation for $32.50, right? So that's the answer for journal entry number 2. Our last journal entry here is related to incremental amortization on intangible assets, and it's going to be very much the same as what we just did for PP&E. So going back to the valuation report from Goodman Thomas, if we focus on footnote 2, well, we can see that the increase in fair value is driven by trade name and customer relationship. However, the trade name, has an indefinite useful life, right? So there's not any amortization related to trade names. But for customer relationship, for that $500 increase in fair value, the useful life is 5 years. So you can see in our schedule for the customer relationship, well, we would take that increase in fair value of 500 divided by 5-year useful life, and that means incremental annual amortization is $100. But again, that's for a full year. We only need 6 months, so we multiply by 0.5, and that tells us incremental amortization is $50. And for trade name, well, indefinite life, so we're not doing anything there. So when it comes to the journal entry, we would just debit amortization expense for $50 and credit accumulated amortization for $50 as well. All right, so that's the correct entry for journal entry number 3. So there you have it. We've completed the 3 different journal entries that needed to be recorded to eliminate the subsidiary, right, that was acquired by Ryan Company. So you can see the bulk of the work related to that 6-step mental map for the acquisition method. That's why it's super important. And we performed those 6 same steps that we did for the multiple choice questions, even though there was all these extra exhibits and it looked more daunting. And this one has actually been based off a real transaction, right? So even if you were hired as a paid consultant to perform this work, it would be very similar to this. And that's what we wanted to give you here, a real life scenario, because that's what the exam is all about, right? It's not some fictitious story. These things really do happen in real life. So keep that in mind. Make sure you know the mental map 6-step approach for the acquisition method, and you'll be all set.